My name is Brian Masterson, and I'm here with Burton Williams. Welcome to Lipscomb University's College of Business Summer Webinar Series. And today we're going to be talking about the financial and tax implications of COVID-19. And as you can see from the slide deck, there's quite a bit for us to talk about. So Congress actually has been busy with respect to drafting legislation, especially with respect to relief provisions. The CARES Act, which is what I know we're going to spend a fair amount of time talking about from the tax perspective, was very much so a relief bill. It was not necessarily a stimulus bill, and we'll talk a little bit more about that. And then Burton will walk us through the Secure Act. And so just by way of introduction, as you could see from the initial slide, I have two roles. I am the director of the Masters of Accountancy program at Lipscomb, and I'm also chair of the Accounting, Finance, and Economics department. But in addition to my academic work, I'm also a practicing tax lawyer with Butler in the Nashville office. And further background, I am an M&A tax lawyer. And so a lot of the more individual issues that Burton will talk about that affect individuals from a financial perspective, those are not necessarily in my wheelhouse. And so that's why we have Burton on the call. So Burton, I'll let you introduce yourself.
And vice versa. The things that Brian will be talking about, you're going to fare much better hearing from him on those. I've been in higher ed now for about 20 years, been doing planning for the last 26 years, started at Wachovia Securities, which was purchased by Wells Fargo, and neither of those are still in existence. But I'm currently the president of the Financial Planning Association of Middle Tennessee. We have about 200 members here in Nashville, and I teach financial planning in the College of Business. And the way I get paid mostly is to do fundraising at Lipscomb and do philanthropic planning. That's where I've spent most of my time the last couple of years. So it's great to be with everyone, and look forward to an interactive session, especially as you ask questions maybe towards the end.
Great. And Davis, if you could move to the second slide, which is where the agenda is located. And as I mentioned, I just want to give everyone an idea as to the roadmap. We are going to talk about financial planning from an individual perspective first, and the Secures Act, which was passed in December of 2019. And what's interesting is the Secures Act had no contemplation whatsoever with respect to the coronavirus pandemic that was coming towards us at that point in time. So when this was enacted way back in the good old days, we had no idea what was coming along the lines of COVID-19. The second major item we're going to talk about deals with all of those tax provisions that are in the CARES Act. And the CARES Act clearly contemplated providing relief. How do we get cash using the IRS? How do we get cash in the hands of corporations? How do we get cash in the hands of individuals? And the CARES Act was expressly designed to be that mechanism to do so. And we're going to spend a fair amount of time talking about the CARES Act and the tax planning that comes out of the CARES Act, and also tax compliance that comes out of the CARES Act. The third major category that we're going to talk about, but we're not going to spend a whole lot of time because they're kind of running towards the end of the life of the Paycheck Protection Program. That was something that was part of the CARES Act, and there was a whole lot of momentum with respect to the initial $349 million funding. It was quickly consumed in early April, and it was re-upped to where I think it was $649 billion that was available, and that has not been used up. And so we're going to talk a little bit about how there is still money out there to be had, and the application period is still open, but we're not going to spend a whole lot of time talking about that relative to the first two parts. The fourth and final part that we're going to talk about deals with what's next. What may be coming out of Congress? What may they be doing in Washington with respect to additional relief? And we'll talk a little bit about timing and also some of the substantive items that Congress has been kicking around this summer. And that sort of debate will begin in earnest here in the next week or so. But anyway, Burton, I'm going to turn it over to you and let you walk through the first item on the agenda, which are the financial planning considerations during this pandemic. So Davis, if you would move to the next slide, that would be great.
Thanks, Brian. This is just sort of a summary of the 5 major points. The Secure Act did a whole lot to affect retirement accounts, both individual retirement accounts, or what we call IRAs, Roth IRAs, and also 401ks or 403bs if you're at a nonprofit. The 5 big ones here, and there's some other things, but we're just going to hit these today. The required minimum distribution age increased to 72. We'll talk about that. It used to be 70 and a half. The age limit for IRA contributions, that's been removed. So you can, as long as you're still working and have earned income, you can make contributions to your IRA. That used to end as you started to take distributions. Inherited retirement account distribution now has to be taken within 10 years. This is a real, in my mind, a killer to some of the plans that I've been involved in, where we implemented stretch out IRAs, and I'll explain that a little bit more. New parents, this is brand new, can take penalty-free withdrawals from their retirement accounts. This used to be limited for medical emergencies, any type of financial hardships, or buying your first home. Those were actually loans. These are not loans. And then last, long-term part-time employees are now eligible for 401k plans. Typically, that was only folks that worked at least 1,000 hours. And now if you work 500 hours and you've been working in that same place in that part-time role for 3 years, then you can take advantage of that. Davis, let's go to the next slide and we'll look at each one of these. So on the distribution age now, if you hit 70 and a half in 2019, you will still need to take your required minimum distribution for 2019. That's something that a lot of people aren't considering because they're like, oh, I've got an extension, I'm perfectly fine. But if you did turn 70 and a half, you do have to take a distribution. Now you have till April the 1st of this year to take the distribution for last year. And so it depends on when you turn 70 and a half. You might have a little bit longer to do that. And then 2020, you don't have to take a distribution until you're 72. So that's a big deal. And that's in 2021. And so I just wanted you to see that if you did turn 70 and a half, or you know folks, or you're doing planning, last year, they will have to take a distribution this year. They will not be able to wait till they're 72. So that's a pretty small one. Let's move on to the next one. No more age limit for IRA contributions. So the Secure Act is going to allow people to continue to pump up their retirement savings while they're continuing to work. As you know, people are living longer, they're working longer. A point on Social Security: if you hit your normal retirement age, which if you were born after 1960 would be 67, you can continue to work until you're 70 and increase your Social Security payout. So we were already encouraging people in a way with Social Security to work longer, to contribute longer. In this way, you can work after 70 and continue to put money as long as it's earned income. And the important thing there is that if only one spouse is working, if you're married, then you can contribute to both your IRA and their IRA. If you're 50, you can contribute $7,000. If you're below 50, $6,000. So if you're over 50, you have at least one spouse working, you can contribute up to $14,000 into your IRA, which is great. And if you're working, many people are working past 70. The president of the United States is obviously, 74. He's up there. Biden is as well beyond that. So they're still working. But that's something I wanted you to know, especially for those that in their financial plan, they've already decided, COVID's been a killer and my retirement's down, or I've lost my job. I had to actually pull from my retirement. This gives you a little bit of extra help. And that's really the purpose. That was the purpose of the CARE Act, not the Secure Act, but it actually ends up helping us out during the CARE Act as well. Okay, let's go to the next slide. This is one that kind of scratched my head about inherited retirement accounts. Normally, if you were the primary beneficiary of a retirement account, you could take distributions from that inherited IRA over the remaining lifetime and your lifetime of the decedent. So if their normal distribution time period was another 10 years based on their age, and you are much younger, you could stretch that out over 20 years. Why would you do that? Well, because you've never paid taxes on the money that went in those accounts. So it's much better to take that out over a longer period of time to mitigate the taxes. Now, sometimes when you get inherited assets, you want to spend them immediately, and that's not a concern. But the wise planning technique here is to, if you inherited cash or you inherited property, those are the type of things you work with currently. You want to wait and take distributions out of those retirement accounts as long as possible. So now this has to be, the total account has to be withdrawn in 10 years. Okay. So instead of the 20 or 25 or 30, it's now 10 years. This does not relate to a surviving spouse. So a surviving spouse was the only beneficiary of an IRA that could actually take that IRA from his deceased wife or her deceased husband and make it their own account. And then they could take it out over their life expectancy. No one else could actually take that account and change it into their own account. Minor children do not have to take it out in 10 years because they're minor children, and they can't make those decisions sometimes until they're 18. Disabled or chronically ill, they do not have to take this out within 10 years. So there are some exceptions, but everyone else has to take it out over 10 years. And if someone is 10 years younger than the IRA owner, that would also be an exception. So what I want to remind everybody to do today is check your beneficiary designations, because I know, especially when I was doing planning at Wachovia, everybody I would recommend try to do the stretch IRA. And so we had people set up where the beneficiary would be never the estate, because it would have to come out within 5 years or in a lump sum, but a live beneficiary. Well, you need to check that. And I also want to remind folks, when it comes to estate planning, your estate plan, your will does not designate where your IRA goes. That's one of the common misconceptions in estate planning. And so what happens is an IRA goes by beneficiary designation. Whoever's name is on the beneficiary designation, that's who will receive that IRA. It goes by what's called operation of law. It does not go into your probate assets. Your will cannot control it. So that's another thing to be mindful of. Take a look. We should always review our wills every year to see what we've done, and make sure that you check the status of that with your financial planner, your attorney, your tax provider. Okay, let's move on. Brian, did you want me to hit anything else on the stretch or how it works?
No, other than I think, at least in my practice, the stretch IRA going away or not being as good a tool has been a pretty significant, of all things in the Secure Act, it was by far the most significant thing that I saw that was impacting my practice, because it was not uncommon perhaps to have, to have significant assets that were held inside an IRA.
Right.
And people love the stretch IRA, and now that's not as stretchy as it once was.
Well, and you can imagine whenever these bills get passed, these laws get passed, we've got to figure out a way to pay for them. And so with taking stretch IRAs away, the federal government's going to get their hands on the tax from those accounts a lot quicker. Now, this again was done before COVID. So this is a way of trying to generate revenue for the federal government. Before that, I don't know that they would have done this if COVID had already occurred, or if this was, and they could have reversed this. I guess, Brian, you could tell me if that's not the case in the CARE Act, but I guess they figured out the retirement part had already been all taken care of. But it's a significant concern, and I certainly wish they hadn't done it. But we'll continue to try to find innovative ways to work around it. Okay, let's go to
before you move on. I just want to, Burton, you planted a seed that I want everybody to keep in mind when we talk about taxes in the next segment. A common question that I'm getting from clients is, okay, we're getting all this relief now. Who's going to, or how are we going to pay for this? And the answer is in the form of higher taxes.
Right.
So there will come a time to pay the piper. And it may not necessarily be in the next 5 years. It may be in the next, 5 to 10 to 15. And then that gets into the whole issue in terms of generational. matters. And so are we in a situation, a question that I hear people talking about in Washington is, are we basically putting a double whammy on, the students who are now graduating from college, in the sense that they're graduating into a very, very difficult job market. And then, oh, by the way, not only are they going to have trouble finding jobs, once they do find jobs and they start hitting their stride when they turn 30 and 40, where our tax rate structure is going to be significantly higher than it is right now. So at any rate, at some point, we are going to have to pay for all of this.
And before I switch it back over to Brian, when I conclude on the Secure Act, I am going to talk a little bit about Roth IRAs. And so I'll bring up another point in trying to figure out, well, maybe I need to go ahead and be taxed on some of my income today, because I know tax rates are never going to be as low as they are right now. Some people feel that way. And so it may make sense to do some converting of IRAs into a Roth IRA. So we'll talk about that in a minute. Okay. So another item I mentioned, this is called the QBOAD, qualified, I guess it's birth and adoption distribution. And so the IRS is allowing penalty-free early withdrawals from your retirement accounts for expensive medical emergencies or to purchase health insurance after a job loss. You're allowed to take $5,000 out of your IRA after the birth or adoption of a child. Now, that's one of the challenges, because those of you who have adopted children or know people that are adopted children, a lot of the cost is paid out before the child is adopted as part of the legal work or the traveling. You actually have to have the birth certificate to take this distribution, okay? And so this is after the child has been adopted, not before, or after the child has been born, the natural birth. And so that's one thing to think about. Now, if both the spouses have IRAs, then you can take $10,000 out, okay? If you are adopting twins or multiple children, you can take $20,000 out. I didn't find, when I was researching it, if you have twins naturally that are not adopted, and so that's, I think you could probably do the 20, but I don't write that down. I think you need to do more research or ask your tax provider on that. So up to $20,000 if you adopt two children, that's a significant amount. There is no time frame on this. You do not have to pay this back in a year or two. Now you are going to lose the tax deferred growth in your IRA account, and if again you don't save it again, you're going to lose the investment earnings. So investment earnings and the continued tax deferment of those earnings if you don't pay it back. But unlike the hardship withdrawals that I mentioned earlier in the introduction, those are actually loans. This is not a loan. There's not interest, and there's no penalty. So if you're taking withdrawals before 59 and a half, you would typically have to pay a 10% penalty. There's no penalty, and you don't have to pay any other fees to take this out. But you are going to have that opportunity loss of the savings. In addition, the IRAs, if you have an IRA, it's going to be a little bit easier to do this. Some 401k companies that offer 401ks, they are still trying to figure this one out. And so they may not allow you to take a distribution immediately. They may have a waiting period. One of the challenges we ran into is figuring out the withholding, because typically when you take a distribution from a retirement account, there's a mandatory 20% withholding. You can get around that if you deposit those funds back into an IRA within 60 days. That was extended a little bit as well under the CARE Act, but that deadline was July 15th. And so on the 401k, that's something that we're still trying to figure out, but I believe all the 401k companies and all the experts out there are saying there's a 10% withholding that may be applicable, but again, they're not sure. And so it may take them a little bit to figure it out, but on your IRAs, it should be simple because you will get a a 1099 R at the end of the year, and you'll be able to note how you took that out, and you can go ahead and do it on an IRA. So I wanted you to know about this very, very generous withdrawal. I'm not sure the planning smart of this, because it is going to hurt you long term unless you put that money right back in. And so, some people might have done this thinking there'd be another stimulus down the road and they'd pay it back with that, or they may be using their stimulus money instead of the $5,000 and not withdraw. But it is there for your availability. Next slide, please. I got a little wordy on that one. Long-term part-time employees, I mentioned this. Again, before the Secure Act, you had to work 1,000 hours during a 12-month period to contribute to a company's or corporation's 401k or a nonprofit's 403b. Under the Secure Act, if you work at least 500 hours, so you're part-time, and you're 21 years old or older, and you did that time, you worked in a 12-month period for 3 consecutive years. So you have 500 hours for 3 consecutive years. You can show that, then you should be able to go into your 401k plan. Now, if you have not heard anything from your employer, you need to ask them about it. They may, again, still be trying to figure this out, but they should reach out to you if you're working at least 500 hours. And so I would check on that. This is a great opportunity. So whereas the other one kind of hurt retirement savings long-term, this would help you. So there is some give and take when it comes to the Secure Act, but I wanted you all to be aware of that. The last slide I'll talk about would be for more 401k options. Companies are being able to utilize some additional tax credits. And so the 401k plan now is more available for workers at small firms instead of a SEP IRA or a simple IRA or just an IRA, Roth IRA. There is the availability of 401k. So if you work for a small firm, you don't currently have a 401k, you might talk to your benefits coordinator there, talk to your boss, or you may be the boss. And so this would be something that would help you tax-wise to offset some of the revenue, the tax on revenue, by utilizing some of these tax credits. It also would, of course, provide more guaranteed lifetime income options, annuities, and employer-sponsored 401k. So I won't talk about all of those today. I just want you to be aware that if you work at a small company, typically they don't have 401ks. This is something to look into. And one reminder, this has nothing to do with the Secure Act, but it does have to do with retirement planning. Back on the Roth IRA. So with an IRA or a Roth IRA, you can contribute $6,000 a year, $7,000 if you're over 50. Okay, so don't lose that ability. Another thing, and again, if you think taxes are going to be higher later, talk to your tax advisor, talk to your CPA, talk to your financial planner about maybe I need to make a Roth conversion from an IRA to a Roth IRA. You pay the taxes up front now. You never pay taxes again. Your heirs, your beneficiaries never pay taxes again. You don't even have to take distributions from a Roth IRA. Your heirs will have to at your death, but there's no tax. So it's a really great funding vehicle. There is an income threshold on that, and so you need to be aware of that. I believe it's $203,000 for a married couple. If you're at that, you cannot do a Roth IRA. And then the HSA, real quick. The health savings account, you can make a maximum distribution in 2020 or in addition to one of those of $3,050, $7,100 for family. And even if you don't use this for medical expenses, this can be valuable income during retirement. And so in addition to the IRA and the Roth IRA, in addition to your 401k, you have that HSA, and look at it as a retirement vehicle. I'm done for now. Go ahead, Brian.
Outstanding. So before we move on to our second item on the agenda, Burton and I are monitoring the Q&A box. So to the extent that you have questions, feel free to type them in there. I know the chat feature has been disabled for purposes of this webinar. So if you have questions, type them into the Q&A box, and we'll try to incorporate them as we're moving along. So The second major item on the agenda concerns the important tax provisions that were in the CARES Act. The CARES Act was signed into law on March 27th of this year. And as I mentioned in the introduction, it clearly was designed to be a relief bill. And it was designed to get money, cash, into the hands of corporations and taxpayers as quickly as possible, and also provide deferral mechanisms so that from a tax perspective, taxpayers were not having to make payments by April 15th. And so we all benefited, or those of us who just filed our returns yesterday, we benefited and made payments with those returns. We benefited from the extra 3 months to not have to make that payment on April 15th. And so those are mechanisms to where Congress and the White House were looking to help taxpayers manage cash flow better. And so a lot of these provisions we're going to be talking about, I think are going to be fairly obvious that they are designed to provide relief to the form of tax refunds. One thing to note, and I can tell you when I'm talking to clients about these issues, a lot of these provisions, I'm like, you may want to amend your return. And so that's where you need to reach out to your tax return preparer and run the numbers. Running the numbers is always important, but I would say now it's even more so important to run the numbers because it may make sense to amend your return. So at any rate, by way of background, that's that. So the first item I want to hit is there is no income on cancellation of debt or for loan forgiveness with respect to the Paycheck Protection Program loan. We're going to talk about those briefly in our third segment, but as I mentioned before, those are loans that individuals, self-employed individuals, entities that are engaged in trade or businesses, tax-exempt organizations, those are loans that certain types of entities that qualified for these small business loans were able to get those loans. And to the extent that you use those loans for excludable purposes, you don't have to pay it back, and that does not generate cancellation of debt income. Ordinarily, when a debt is forgiven, it is income to whoever benefited from that debt forgiveness. CARES Act said, well, that's not the case with respect to these particular loans, because otherwise we would have said with one hand, oh, here's a loan and we're not making you pay it back. But at the other hand, we said, well, you got to pay tax on it now. So Congress rightfully, with respect to what they were trying to do here in terms of providing relief and maximizing cash to the hands of businesses who needed cash to continue to pay people, even though people weren't working. Congress said that's not income to the extent it's forgiven. Now, here's what's interesting. And I did not put it in the slide because we don't yet know what's going to happen here. And so this is somewhat foreshadowing of what may come from Congress. And that is, you may recall in the press how I'll even back up. You may recall that the IRS, when asked, well, what about all these expenses that I am incurring that are not subject to having to repay this debt? Like, for example, my rent or my mortgage. Well, that's a qualified expenditure. And if I use a PPP loan for that purpose, I don't have to pay it back. And I don't have CODI. Can I also take a deduction for it? Because ordinarily I would be able to deduct it. Or what if it's payroll or rent? And the answer was from the IRS, sorry, you're already getting one free pass in the sense that that's not income. We're not giving you a second pass, which is you can also deduct it. The IRS's view was, my goodness, that's a double dip. And we typically don't like double dips. So IRS came out with that in the form of a notice towards the end of April. That got a lot of consternation in the press. AICPA came out against it. But I also tell you that if you just look at tax law, the arguments are better on the side of it not being deductible, which is the position that the IRS took. Now, here's what's interesting, though. Congress didn't like it. Congress can change the law. So Burton was asking about changing the law. Congress can change the law. So you had the three most senior members of the two tax writing committees on Capitol Hill wrote a letter to the Treasury Secretary saying, well, we disagree with the IRS's conclusion that these expenses that people are paying should not be deductible because the income, you didn't make them pick up the income with respect to the cancellation of debt. So do I think that something's going to come out with respect to what Congress may be doing probably next month? Yes, I think Congress probably will address this issue because The letter that was sent to the Treasury Secretary was clear. It was our intent, from Congress's perspective, to maximize the deductibility and to maximize the not including of income. So if we need to change the law, we will change the law. So I thought that was kind of interesting. All right, second point, rebates. Hopefully, to the extent you qualify for a rebate, you had no problem getting your rebate checks. There were limitations on that. But what's interesting here is, in listening to various podcasts in terms of what economists seem to think about the reaction that various nations have had, this particular provision has been viewed as one that was most favorable. What other countries are doing, and you may have heard about this, the UK has some sort of eat out type program, which I find to be a little bit ironic. They are providing for up to £10. So you go to a restaurant in the UK to eat in, and let's say your bill is £20. Well, instead of paying £20 to the restaurant, you would pay £10 to the restaurant, and the restaurant would then apply to the British government and get the other £10 paid for by the British government. And that was a stimulus bill or stimulus provision that was introduced in the UK, and it's been somewhat laughed at, saying, wait a minute, are we in the middle of a pandemic and you're wanting us to physically distance and not be inside in large gatherings, and now you're encouraging us with this stimulus provision to actually go to restaurants? It's laudable in the sense that, yes, in order to support restaurants, people need to dine in, but I thought it was a little bit interesting from a public health perspective what the UK was doing. Other countries are, I think Japan is providing up to $200 for you to travel. Within Japan, they're doing something similar to that. I think there was a Scandinavian country that is encouraging people to go to beds and breakfast, and they'll pay for part of your bed and breakfast. It's just different ways countries are trying to stimulate certain types of economic activity, whereas this economist who was talking about the different provisions said, well, the US actually got it right. They just said, here's cash, and we know you need cash, and you decide how you want to use that cash. We're not going to say, oh, you can get this benefit if you go to a bed and breakfast, or if you go to a hotel, or if you go to a restaurant. It's here's your cash. You do with it as you need, as you see fit. So that's actually kind of interesting what we did with respect to these rebates, which were actually advance credits with respect to 2020. The third item on this slide actually is somewhat related to financial planning, in the sense that it's designed to provide people with an opportunity to, without having to pay the 10% premature penalty if you've been adversely affected by COVID-19. Then you can pull out of your retirement account up to $100,000. And that's designed to provide people with a funding mechanism so that you don't have, if you're in a situation to where you've been furloughed due to coronavirus, or you've been ill due to coronavirus, and now you don't have your compensation from your job or from your business, and you need to tap into some retirement account and you're not yet 59 and a half, well, here's a means to do that in a way that's not as punitive as it would have been before. So that's a very helpful provision. Davis, can you flip to the next slide?
And just while you're doing that,
sure.
This one, if you don't pay it back, then you will be taxed on it. And I've seen this. I don't know if it was a year or 3 years, but there is a window that you do have to put this back in your account, or you will pay taxes.
All right. On this next slide, you can also see the temporary waiver, and this is the very first bullet point, the temporary waiver of the required minimum distribution requirement for distributions required for April 1st. So a lot of the deadlines that Burton was giving you, some of those potentially have been moved based upon coronavirus. And so I would say, obviously that time has passed, but I would say double check that. If you're in a situation to where you have a required minimum distribution that needs to be paid this year, but you don't need it, I would take a closer look at, could you possibly take advantage of this temporary waiver? The next bullet point deals with charitable contributions. This is in recognition, Congress's recognition that charities will be stepping in to provide relief whether it's a food bank that is going to be stepping in to provide relief to families that are no longer have jobs and they need help basically putting food on the table for their families. Just a recognition that there's going to be a need for charitable organizations to step up and fill the gap that state, local, and federal governments will not simply be able to do so. And so there was an easing, and in fact, there was an elimination of the limitations that apply to individuals who make charitable contributions. So the 30%, 50% of AGI, 60% of AGI limitations that apply post the Tax Cut and Jobs Act, those are suspended temporarily for individuals, and also regardless of whether or not you itemize your deductions, there is an up to a $300 above the line deduction for individuals who make charitable contributions. For corporations, they've increased the taxable income limitation from 10% to 25%, again, trying to incentivize taxpayers with enhanced deductions for making even larger charitable contributions. So funding for exempt organizations can increase. All right, the next bullet point deals with the refundable payroll tax credit. That's something that you continue to hear the White House talk a fair amount about, which would be either refunding or cutting the employer piece of the payroll tax mechanism. So there are certain types of employers who can qualify for a refundable payroll tax credit. That's a little bit different than the deferral mechanism that we'll talk about on the next slide, but that's a possibility within a narrow construct. The fourth and final bullet point on this slide deals with something that, again, it goes back to trying to help, recognizing that students today have quite a bit of student debt and finding other mechanisms to help students pay for that debt. Here it's allowing employers to pay on student loans up to $5,250, which is the amount. That amount's familiar to some of you guys. It's because that's the amount that employers can pay per year on tuition for an employee to go back to school. And so here they're saying, well, let's expand that and say that you can also make payments on student loans that current employees have taken out. So it doesn't necessarily have to be for tuition in the 2020 year. And so that's an expansion on that particular provision. Davis, if you can flip to slide 12. This first bullet point deals with the deferral mechanism with respect to employer taxes that are paid with respect to wages. And so you can see there that there is deferral mechanism, there is a deferral opportunity. And so this gets back to what was Congress' intent here, which was to say, look, no different than we did with tax returns that were due on April 15th. We deferred payment of those taxes until July 15th without penalty or interest applying. What they're trying to do here is to say, okay, if you are collecting payroll taxes as part of your weekly or biweekly or monthly payroll process, we'll allow you to defer payment on that until later dates. And you can see, quite frankly, it's very beneficial. You pay 50% at the end of next year, and then the balance at the end of the following year. And so I know this is a benefit that initially the rule was with respect to the CARES Act, the initial drafting of it, the one that was enacted on March 27th, was if you're taking a PPP loan, this deferral is not available to you. And so a lot of my clients are running numbers with their accountants to say, does it make more sense to get the PPP loan, or does it make more sense to not do the PPP loan and take this deferral mechanism? The PPP program has been amended several times, and we'll look at this in just a few minutes. And in the June amendment, they took out that prohibition. And so now, if you have a PPP loan, you can still benefit from this deferral mechanism. All right, the next point really begins a laundry list of different points that you should consider amending prior year returns to take advantage of. The first one, NOLs. So the Tax Cuts and Jobs Act put pretty significant limitations on the ability of taxpayers, and this would be more for corporate taxpayers, although it can impact S corps and partnerships, but it's more of a corporate tax issue. But pretty significant limitations. It said basically your maximum deduction is 80% of your current taxable income. So even if I have NOLs, significant NOLs carrying forward from prior years, the most I can do is offset 80% of my current year tax liability. So I'm still going to be paying tax on at least, that 20% that I could not offset. And it was also eliminating the carry back regime. And so if I had generated an NOL, all I could do was carry it forward. Well, what Congress did here was to say, and they've done this before, they did this back in 2009. So this is a pretty easy tax relief mechanism, or it can be used for stimulus, which is what happened in 2009, was to say, okay, we're going to let you unlock these NOLs. We're going to let you monetize them. And so what Congress did, they said, okay, we're going to suspend the 80% limitation that the Tax Cuts and Jobs Act enacted, and we're going to allow you to carry it back up to 5 years. So you may recall that one of the big points of the Tax Cuts and Jobs Act, which was enacted in 2017, was it cut the corporate tax rate to 21%, and it's a flat 21%. So in years 2017 and before, you could have been paying 35+% tax, and your effective tax rate could have been in the upper 20s, low 30s, which is significantly higher than 21%. So if I can carry back 5 years, so I have an NOL in 2020, I can carry that all the way back to 2015 when my tax rate is much higher. That's a really good deal. And so again, that was a way for Congress to try to provide relief. And the way you do it, the way you claim it, is through an amended return. So you would amend the 2015 return. It's pretty easy for a corporation to amend their return. It's not so easy for a partnership. And so the IRS has had to issue revenue procedures dealing with special relief for partnerships. And I don't want to go too far down, but partnerships are not really allowed to file amended returns. It's called an administrative audit request. You actually have to get the permission of the IRS to amend your return. And so it's a little bit more difficult. Partnerships are like, wait a minute, we would like to be able to take advantage of this. Well, you can't, absent relief. And so IRS has provided that relief and said, okay, here's the mechanism in which we will allow, with respect to NOLs, partnerships to bypass the administrative audit request process, which is a long, cumbersome process, and has other limitations that are beyond the scope of what we're going to talk about here. But there are mechanisms in place to allow partnerships, S corps, C corps to take advantage of this very, very important provision. The next point. This is the excess business loss limitation that came in to being with the Tax Cuts and Jobs Act of 2017. And this is basically offsetting that, saying we're going to suspend that for the time being. And so to the extent that in 2018, 2019, you had losses that were flowing through to you that were suspended because of this new provision from 2017, well, we're suspending that. And so again, to the extent that you had a tax return that was subject to that excess business loss limitation, then I would say give strong consideration. In fact, I would say you probably should amend your tax return. All right, Davis, if you can move to slide 13. Business interest expense. Again, a lot of these provisions were things that came in 2017 that Congress is saying, well, maybe we should undo them for a limited period of time. The business interest expense, that's long been an issue that Congress has looked at, different White House administrations have looked at, basically gets into it's the issue of why is interest that I pay on debt deductible, whereas dividends that I pay on corporate stock are not deductible. And so there was always tax law favored interest expense. Well, one way to raise revenue, which is what they did in 2017, was to say, well, we're limiting the amount of interest that a business can deduct. Well, when you're trying to create relief, a relief mechanism, you basically increase the percentage of income that you can then deduct. So here's what they did. They said your business interest expense limitation has moved from 30% to 50%. So instead of being limited to 50% of your adjusted taxable income, we're now increasing that all the way up to 50% so you can deduct more in 2019 and 20. And so that was very beneficial. And again, If you've got a highly leveraged enterprise where you've got a lot of debt, you may want to amend your 2019 return. And if you're in a partnership, you probably already filed. Partnership returns were due on March 15th. The CARES Act was not enacted until almost 2 weeks later. So you may have already filed a return for 2019, which you would consider amending. We'll skip over the next point. We've already covered that. The third point, qualified improvement property, another huge issue. This was a technical correction with respect to the 2017 Tax Act. Qualified improvement property is, think about leasehold improvements. So go to your favorite office building or retail space and everything that's inside it. So the walls, the carpet, the fixtures, all those things are considered qualified improvement property. And so imagine all of the leasehold improvements that would be necessary to get any retail space ready for the public or any office space, ready for commercial tenants to step in. Well, I mean, you could have millions of dollars of tenant improvements that under the Tax Cuts and Jobs Act was, this is a drafting error, were treated as 39-year property, when before the law, they've been treated as 15-year property. Well, this is a technical correction that says, well, it should have been retroactive to the Tax Cuts and Jobs Act, so retroactive to January 1, 2018. Those tenant improvements, which are considered qualified improvement property, should have been eligible for bonus depreciation, which means they're immediately expensable. Huge issue. I mean, a huge issue. So to the extent that you have qualified improvement property, let's say you own a partnership or involved in a partnership that has rental real estate and you have significant tenant improvements, highly recommend running the numbers, but I think more likely than not, your numbers are going to say we should amend to take advantage of that. All right, fourth and final point on this slide. This is purely a corporate issue. The Tax Cuts and Jobs Act eliminated corporate AMT. AMT is the alternative minimum tax. It still applies for individuals. And so if you filed your tax return yesterday, you may have enjoyed the privilege of paying some alternative minimum tax. Corporation doesn't exist anymore. And so as a transition mechanism, what Congress did, they said, okay, effective 2018 and beyond, when there is no more corporate AMT, to the extent you've been paying corporate AMT, we'll let you take that corporate AMT that you paid in the past, let you take that as a credit to offset your regular federal income tax over a number of years. What the CARES Act did was to say, forget it, you can do it now. So you could take all of those credits and accelerate them to 2018 and 19 so that, again, if I'm able to maximize those credits, use them all up, I'm able to reduce the amount of tax that I'm having to pay in 2018 and 19 and actually can get them refunded to me. Again, another way to put cash into the hands of taxpayers. To the extent that you've already filed the 2018 return, as you should have, you can do an amendment, or you can include it on your 2019 corporate return if you've not already filed it.
Hey, Brian, before we move to the PPP, and I know we only have 10 minutes, back on the distribution up to $100,000 under the CARE Act, I believe I misspoke. I meant to say you can pay your taxes on that amount over 3 years, not that you have to put the money back in 3 years. You can pay them all in the year you take it out if your income is really low, or you have up to 3 years to pay the taxes back.
All right, Charles has a question for you. Charles Frazier. You see his question in the Q&A? Charles's question is, should a charity be shown as a beneficiary on an IRA plan?
I love those loaded questions from Charles. If a charity is a beneficiary on an IRA plan, they are deemed a corporate beneficiary. And so if you have non-corporate beneficiaries and a corporate beneficiaries, the entire IRA has to be distributed in a lump sum immediately. Well, within 5 years or a lump sum. So there are ways you can either separate out your IRA, give this part of your IRA to charity, and give this to live beneficiaries. And so that's really a challenge. And we can also do that through a trust that becomes irrevocable at death. But no, you should not include a charitable beneficiary along with other beneficiaries. But if you don't have other beneficiaries, it's perfectly fine because charities don't pay income taxes. It's a great asset to give to charity. I don't know if that's kind of where you were going with that, Charles. But.
All right, so we've wrapped up the first two, and by far the largest two segments of what we wanted to talk about. Uh, Concluding thoughts with respect to the CARES Act and the tax-related provisions in the CARES Act. Hopefully, as you can see, we just ran through 4 dense slides of many, many changes that Congress enacted at the beginning of really the U.S. heightened experience with the coronavirus pandemic. And my sense is they seem to do a pretty good job of hitting the right levers in order to provide cash or defer payment of cash to taxpayers. And so it'll be, now there's still work to be done, and we'll talk about that in our 4th segment, but I think they did a nice job in terms of doing things very, very quickly. And largely in a very bipartisan way, which is a good thing as well. So Davis, if you'll move to the next slide, slide 14. I just want to walk through these 4 dates, and I provided you with basic information on the next several slides after this that I'm not going to cover in depth, because there's been so much written in the mainstream press about the PPP program. I just want to hit some highlights just to make sure you guys are following along. So we've already talked about March 27. March 27 was when the CARES Act was enacted. The CARES Act had those tax provisions, plus it also had the Paycheck Protection Program. April 24th came about because the initial $349 billion was consumed even before the application period ended. So the initial application period opened, I think I'd have to go back and look, April 3rd. And I'm pretty sure by the end of that first week, it had been fully consumed, and it was clear that there was heightened demand from small businesses for these loans. And so on April 24th, you can see there's another pretty large chunk of cash that's committed to this program. So on April 24th, the authorization level with respect to the PPP program or PPP loan program was $659 billion. There were still some issues that were surfacing in terms of questions that were coming up were, do I have to make all these payments within 8 weeks, which was the original rule, or can I space it out over a longer period of time? The June 5 bill was designed to basically extend the time period to apply, but also to hit some of these nuances in terms of percentages, like how much can I spend on my mortgage or my rent? How much can I spend on, or how long do I have? Do I have now 8 weeks? Can I go beyond 8 weeks? And the answer is yes, you can go up to 24 weeks. And so there have been changes that have been made to the percentages that I tried to reflect on the next several slides. Then July 4, which has been the most recent change, was to say, well, we know that the deadline that came about with respect to the June 5 did not use all of the money that was left in the that had been authorized. So not all the $659 billion has been used. There's still money left. I want to say it's north of $100 billion is still left potentially that can be borrowed upon. So the July 4 legislation said, look, we're going to extend the application window for the PPP loan all the way through to August 8th. And so it's still out there, and if you want to apply, you can apply. So in closing, I want to hit the 4th and final topic, and Davis, if you can jump all the way to slide 20. So slide 20 summarizes where we are with respect to what Congress is doing. So the House, and it was basically along party lines, passed the HEROES Act. And I saw Nancy Pelosi yesterday, and she was talking about the HEROES Act and saying that the Senate just needs to pass the HEROES Act, which is now in the Senate. The Senate has said, no, we're not going to pass the HEROES Act. We have our own legislation, and so our own ideas. And that's where you can see in the second bullet point, Chuck Grassley, who is the chairman of the Senate Finance Committee, has said, yes, we have differences. There are certain things that we want in this legislation. And when everybody gets back from their July 4 recess, I think the Senate is back on Monday, House is back Tuesday. We're going to start hammering this out. And as I mentioned before, Nancy Pelosi has said, well, the House may not recess for its August recess when they thought they would, which is August 3rd. So the week of August 3rd is when the House is not supposed to be there. The Senate is going to be there for another week, so the Senate doesn't leave until the week of August 10th. But Pelosi has said, you guys, we may be sticking around a little bit longer to make sure that we get this fourth, or I guess fifth relief bill enacted. The two key sticking points, and there are more, trust me, there are more sticking points, but the two biggest ones that you hear members of Congress talking about, the first one is the enhanced $600 of unemployment relief. That gets back to the issue of a lot of small businesses are saying, I can't get people to come work for me, even if we do open up. I can't get people to work for me because they get paid more as a result of unemployment, plus the extra $600 of benefits, that all of that runs out at the end of this month. And the Democrats and HEROES Act are extending that, and the Republicans have said, no, we don't want to extend that. And so that's going to be a significant sticking point. And then the last one is, I think, probably even a bigger deal, which is Republicans want liability protection. I mean, it even affects places like Lipscomb, or any place of work. So if you're having people come back into your building, back onto your campus, and they end up getting sick and suffering damages, I can almost assure you there's going to be a plaintiff's lawyer looking to create a class so that he can file a class action lawsuit against a number of schools. And nobody wins there but the lawyers. Students don't win, parents don't win. And so what Republicans are wanting would be, we want to have some sort of federal statutory liability protection for businesses that open up in a reasonable way. And Democrats are reluctant to do that. And so be on the lookout for that in the coming 2 to 3 weeks, once Congress gets back in town next week. So,
Brian, you have an additional question on the Q&A about PPP.
There is, I would say, on the triple P, June 5th is a key date. And let me go back, Davis, go back. I think I have a slide on that. Hold on for just 1 second. I tried to make a note where there was a change with respect to the June 5. Let's see if I can see it. Davis, it's on slide 18. All right, so let's see, extend the time. The answer is no. So if you look at the last bullet point on slide 18, here you can see that the 5-year term, which did come about with the June 5 legislation, is if the loan was originated after the date of enactment. So if you have a triple P loan that was originated before, you're still at the 2-year point. So anyway, I know we're 1 minute beyond. If anybody has questions on the last slide, and Davis, if you could jump there. The last slide, we have our contact information. So to the extent that you have questions, feel free to email Burton, feel free to email me, both of us, and we'll do our best to get back to you. But we want to thank you for participating in this Lipscomb College of Business summer webinar series as we've walked through some of the financial and tax implications of COVID-19. So thanks for being here.
Yeah, we appreciate your support.